Hello and welcome to Sovereign Financials, financial education for everyone. Alright guys, welcome back to Sovereign Financials. Today we're going to talk about the repo market and why it's in severe distress today. But first we're going to talk about what the repo market is. Now, under normal circumstances, the Federal Reserve requires that banks deposit money with the Federal Reserve overnight, which is a certain percentage of how much the bank owns, to prove that it's still solvent, meaning that the bank has enough money to perform its daily operations and that the bank is not going to go bankrupt. Now, if one bank is low on cash and another bank has enough cash, has more than it needs to deposit with the Fed overnight, then the bank with more cash can loan so the other bank that does not have enough cash the money, and then that bank can then deposit it with the Fed. Now, of course, in return, that bank owes, so bank one would owe bank two the money back, and some percent interest. Now, when the Fed sets target rates, the Fed tries to target what that interest rate is going to be. So right now, let's say it's supposed to be 2%, and then if for whatever reason though the banks don't have enough money to lend to each other, let's say bank number one is low on money and bank number two, instead of having enough money to lend to bank number one, let's say they're also low on money, so both banks don't have enough money to lend to each other to meet the requirement of money they have to deposit the Fed, well then the Fed can then lend money to both banks. It's kind of like a little circle. The bank would then keep that money in the Fed, and then the Fed charges the banks an interest rate. Now, the Fed does have a cap of what they would do, and the cap for the Fed lending banks money is $75 billion in one night. That's a huge amount of money to lend the banks. The Fed prints that money and then loans it to the banks. It puts it in their bank account, and then overnight, during the next day, the bank is supposed to be able to sell some of their assets or move some of their money around, so they have enough money the next night in order to deposit the right amount of money in the Fed. What's been going on over the past couple of days, however, is that multiple banks don't have enough money to deposit the right amount of money in the Fed, so banks are competing with each other to borrow money from the Fed. And just like in normal supply and demand, if the supply is really low and the demand, because it's capped at $75 billion a day by the Fed, and the demand is really high, then the interest rate has to shoot up. So the Fed targets 2%, and then if there's too much demand, then the interest rate goes up. All right, so let's take a look at this real quick here. So here it says a repurchase. So a repo is a repurchase agreement, and a repo is a form of short-term borrowing for dealers in government securities. In the case of a repo, the dealer sells the government securities to investors, usually on an overnight basis, and then buys them back the following day. Basically, the Fed requires the banks deposit something with the Fed, saying like, I promise to pay you back, and if I don't, you get to take these assets. Those usually are either U.S. Treasuries or mortgage-backed securities. Now, banks have had enough money since 2009 to be able to lend to each other when there's a little bit of shortage without having to borrow money from the banks. But if you look here, and so since 2009, there's only been a couple instances where the banks had to actually borrow money from the Fed because they were not solvent, meaning they did not have enough money to perform daily operations. So unfortunately, my little drawing device doesn't let me draw on this page. But if you look here, on September 17th, there was $53 billion that banks needed of money. That's the amount submitted for the repo. And then, the Fed caps it at $75 billion. Since $53 billion is less than that, the Fed basically printed money and then lent it to the banks because the banks didn't have enough money to deposit the Fed. I mean, basically that's a problem of potentially of insolvency. So the Fed printed $53 billion on September 17th. And then if you go to September 18th, the repo, banks needed $80 billion of liquidity, which is money. And, the Fed caps it at $75 billion. So the banks needed more money than the Fed is basically giving out per night. So this is a severe problem here, right? The banks are not having enough money to deposit with the Fed. The question is why? Is it because the banks have too much U.S. Treasuries and not enough cash? That's probably part of the reason. But if you keep going here, September 19th, repo, look, banks needed another $83 billion, and then the Fed printed another 75 to loan to them. And then September 20th, repo again, banks needed $75 billion, and the Fed printed another $75 billion. The Fed's just been printing a bunch of money in order to save the banks because they don't have enough cash to deposit. And if you look at the repo rate, so remember the Fed is aiming for 2% right now. And the repo rate, because there's such a high demand for money from the banks, and there wasn't enough, didn't have enough money to deposit the Fed, instead of being at 2%, which the Fed's done a pretty good job at, the interest rates shot up all the way almost to 10%. It was 9 point something percent. So almost 10%. So the Fed's aiming for 2, and it got to 10, which means the Fed can't even control their own interest rates, right? This is not good. That's very, very bad. And I just want to show you here that if you look here, so there was one earlier time in 2019 that the interest rate shot up, but here we are, interest rate shot up for the repo market. And if you look though, right, all the way since after the financial crisis in the end of 2009, all the way till now, there has not been any large spikes in the overnight repo rate. So the Fed's been doing a good job of controlling the markets until now. And if you look, okay, well, when was the last time the repo market ended up spiking up like this out of control? And sure enough, you have the 2005, 2009 market crash, right? When the banks were lending out too much money irresponsibly, they didn't have enough money to cover their overnight rates, and the Fed started printing a bunch of money for them to loan to them, and this is what saved them. And then this is the bailout, right? And basically the question is, are we starting another bailout for the banks? So if you look at this article here, it's written on Fortune magazine. It says why the repo market is such a big deal and why its $400 billion bailout is so unnerving. And this article was written on September 23rd. I looked at the previous website, and currently now on September 25th, not including the tonight's overnight, but as of last night's overnight repo, the Fed has so far printed over $500 billion to bail out the banks so far. Absolutely huge amount of money. Let's come down here. A $1 trillion market springs a leak. And I wanted to come down here. So the repo market seized up last week with the median repurchase rate skyrocketing from the usual band of 2 to 2.25%. And then some of the repo rates were as high as 9%, right? More than quadruple what the Federal Reserve's own target rate is. And I think there's one more part down here where it talked about, the Fed ended 5 years ago the policy for quantitative easing. But basically, if the Fed's printing a bunch of money right now to save the banks, right, it's essentially like another version of quantitative easing. And then because of that, it's actually happened on the same day that the Federal Open Market Committee had their gathering, and they lowered interest rates that day by 0.25%, which Trump was tweeting how pissed off he was because it wasn't low enough. And then they also announced right here the New York Fed said it'll continue repo operations through October 10th. So the Fed plans on printing, as needed, $75 billion, sorry for the writing, $billion per day, which is actually per night, right, of liquidity, and basically loaning that to the banks all the way until October 10th in order to keep the banks and everybody else like solvent and keep the machine running. And this is supposedly under what's considered normal market like stuff, right? This is not a normal market. This is a very bad market. This signals to us danger, but the Fed is, obviously saying like, oh, we don't see any recession coming up, we don't see any market corrections, etc. But this does not happen under normal times. This is bad. They also said it's going to involve 3 14-day operations involving $30 billion. So not only are they printing the $75 billion per night, to basically re-lend it out to the banks, but they're also going to have a couple of $30 billion loans, essentially, to keep everybody solvent that will last 14 days. Once again, this is not normal for this to happen. The repo market blowing up like this tells us that people don't have enough cash in order to actually run business. They're not meeting the Federal Reserve's requirements to how much they're able to deposit in the Fed per day, which lets us know like, hey, there's probably another financial crisis coming around the corner. This is not normal stuff, and this kind of a problem doesn't just go away on its own. The Fed will probably have to undergo quantitative easing again, this is kind of a form of quantitative easing on its own, where the Fed starts going out, they print a bunch of money, and they start buying a bunch of stuff, such as like bonds, and then maybe they'll go like down the whole Japan route where they'll actually start buying stocks like in the equity markets. Another article I wanted to show you here is this is from Markets Insider. Over the past 12 months, investors have pulled a record $1.1 trillion out of equities and put that money into bonds and money market funds, according to Bernstein. So, okay, why would you pull your money out of it? So equities are stocks. Equities are stocks. So investors, big investors, are pulling their money out of stocks, right? Like, well, hey, well, the stock market's still going up. Why is it still going up? And that's kind of, and if you look right now, we're kind of getting a little turbulent. But stocks have still been going up, and it's mainly because corporations, so corporate buybacks. So if a company is making a lot of money and they want to give some of that money back to their investors, the way they do it is they buy some of the shares back. So if I own a share and the company starts spending their extra money and buying all the shares back, then the price of the stock goes up, and then people get to make some money from that. So corporate buybacks have been really boosting the market, and then mergers and acquisitions, where one company ends up taking over another company, and then that share price kind of goes up as it becomes incorporated in the big company. But excuse me, those have supported stock market growth even as investors have fled equities. So if people are pulling their money out of stocks, and the stock market is only going up because companies have enough money at low interest rates to buy back to do purchase share buybacks, if they start going low, like they don't start having enough money to do this because banks aren't giving them as many loans, if the buybacks start going down, then the stock market goes down very quickly. So this is, if everybody else is pulling their money out of stocks, this is not a good time to start investing in stocks, hoping that corporations are going to keep getting loans that are cheap from banks that right now are probably having solvency issues, and therefore are going to stop loaning to these companies and then decreasing buybacks, which could then decrease the price of the stock market, and then the stock market can kind of come down. So a very risky time for that. Now, okay, why did they put their money into bonds, right? I have a video if you guys want to check it out. It's look at the corporate bond bubble on my channel. I just posted a video last week. It describes bonds and how the pricing works really well. But basically, the idea behind this is this, right? If you have a bond, okay, right now, and that bond pays you 2% interest rate a year. Now, if the government starts doing quantitative easing again, they go into the market and start buying a bunch of bonds, then bonds start paying lower interest rates. Let's pretend it goes down to 0.25%, right? This is a very small interest rate, and new investors would hate to have this kind of interest rate. But this is all the new bonds are being purchased at this. But if I have a bond at 2%, well, hey, maybe I paid $10 for this bond, but if it's paying 2% and this other $10 bond right over here is only paying 0.25, maybe somebody will give me, $12, let's say, for this bond instead, right? So if I hold a bond at 2% and the Fed starts doing quantitative easing again, going out in the market, buying a bunch of bonds, and then the bond percentage, the interest rate goes down, this thing goes down, then the price of my bond goes up. So this is why people are probably pouring into bonds, because they're expecting the Fed to do quantitative easing. They're expecting another recession and a whole other stimulus of just Fed printing a bunch of money and trying to blow the bubble back up. All right, guys. So that's kind of like the gist of all this. I'm going to say the same thing that everybody else says, and I hate to say it, but if you guys would come down here and subscribe to my channel, I'd highly appreciate it. Everyone says, like, push that like button, push the thumbs up button. I unfortunately want to say the exact same thing. Can you please push the like button? I really appreciate it. It actually means a lot to me. I even appreciate even more if you guys leave comments down below. Let me know what you think of the repo market. Let me know where you think the economy's going. If you have suggestions for future videos, like, I'm all for it. I want you guys to be as informed as possible to make the best financial decisions as possible. All right? Thanks so much, and I'll see you guys next week.